And it seems like just 2 years ago, we were talking about 30% of the world's sovereign debt. Germany is back to negative, which tells us that risk appetite is waning. There's a flight to quality going on, both domestically and especially overseas. For me, the German situation is really the unresolvable nature of what's going on in the Eurozone, at least in the financial system. But clearly, all central bankers need to realize, and probably are coming to the conclusion, that this idea that they can target inflation and that they're going to get any meaningful move out of inflation because of monetary policy is a bit of folly. And I think that the markets are basically saying slower global economy, inflation is non-existent, and financial instability is still with us in some parts of the world.
How much instability? Is it just nervousness or is it real fear? There's a difference.
And I think that's a great point, Brian. The point that I would make about the Eurozone and vis-a-vis the U.S. is they've really never had their recapitalization moment. And I say early after the 2008 crisis, we had a massive stimulus in the form of very cheap borrowing for a long time and a sort of cap on long-term interest rates via quantitative easing. That helped recapitalize our banking system, which U.S. is in great shape. That moment really hasn't happened in Europe, and I think that's where the nervousness is. The failure of the Deutsche Bank merger and other things, I think, point to some serious concerns about what might be happening in the financial system and credit quality by and large across that region.
Well, right now it appears to be all about the trade fight. Dow futures down 270 points right now, James. How does it play out? How do you think that both sides, they can say what they want Friday, both sides saying, oh, things were constructive, or the reality is this. They left midway through the day on Friday and have no signs right now, no concrete number on calendar dates to meet again. How does this play out?
Yeah, Brian, my interpretation of the trade war is that if it dings confidence significantly enough, that CEOs and CFOs stop this reacceleration of CapEx, which I think is the real positive story for the U.S. economy. We're seeing a broadening of the breadth of capital expenditures, and we're seeing an uptick in U.S. productivity, which can be a real great scenario for a late-stage bull run here. But if confidence gets upended, if this trade war protracts, and there does not appear to be resolution, I'm going to watch over the next couple quarters what do capital budgeting decisions look like? Are corporations starting to rein in what I thought was a very productive run in capital expenditure and productivity growth? That, to me, is the longer tail thing that I'm most interested in, and how this uncertainty that has been introduced plays out in the economy.
How can we make money right now, James?
Well, I think you have to stay diversified. I know that's sort of a tired financial adage, but if you look at what's happening to balanced and asset allocation, it's really performing extremely well in the post-tightening period. And I say that because up until 2015, we had a very high degree of correlation between U.S. stocks within the market. That correlation has broken down. The asset allocation trade is back. The non-correlated nature of fixed income is working, especially year to date. And so what I look for is companies with modest leverage to their balance sheet, an ability to reinvest and generate free cash flow. But importantly, if we do have a downturn, we want those companies that have not simply re-levered, financial engineered their way to earnings, but have long sustainable growth rates and bonds, be it treasuries or high-grade credit, that has a lack of correlation or, in fact, a negative correlation to risk markets. That's the evergreen strategy that I think is really going to come back in vogue here as we move post-central bank focused, exclusive focus economic policy.